Good day everyone, my name is Apostol Dana and I will be report the exchange rate forecasting. So, what is exchange rate forecasting? An exchange rate forecasting is the price of one currency expressed in terms of another currency. A decrease in currency value related to another currency is known as depreciation or devaluation. Likewise, an increase in currency value is known as appreciation or revaluation. So, sabi dito, yung pagbaba ng value ng isang currency, ang tawag dito is depreciation. Sa pagtaas naman ng currency ng isang pera is revaluation or appreciation. So, when the exchange rate from two specific points in time are compared, the beginning exchange rate is denoted as EO and the ending exchange rate is denoted as E1. The percentage change in the value of foreign currency related to the home currency is computed as percentage change is equals to E1 minus EO times EO. So, alternatively, the percentage change in the value of domestic is computed as percentage change is equals to EO to E1. The positive percentage change represents a currency's appreciations, while negative percentage range represents a currency depreciation. So, here's some examples for exchange rate. We assume that the exchange rate for the Swiss franchise changed from 0.64 on January 1 and 0.68 on December 31. In this case, the percentage change in the exchange rate for the franchise against the dollar can be expressed in two different ways, but they have the same meaning. From a franchise perspective, we can say that the franchise value against the dollar appreciated from 0.64 to 0.68. So, ito yung example niya. Percentage is equals to 0.68 to 0.64. Ang ginamit na unang equation dito is for foreign currency. Over 0.64 is equals to negative 0.625. For domestic currency naman, we have 0.64 minus 0.68 over 0.68 is equals to negative 0.588. So, the change of exchange rate from 0.64 to 0.68 is equivalent to the franchise appreciations of 6.25% for the dollars and depreciations of 5.88%. So, the important note of the exchange rate change is not equal to each other. So, hindi talaga nag-equal yung rate ng dalawang foreign currency at saka domestic currency. So, the percentage change in the exchange rate differs because the base rate from which it measured differs. The forecasting needs of multinational companies. So, we have the hedging decision. The hedging decision, from the word itself, hedging means to limit or to qualify something by conditions or exemptions. The hedging decision is to offset the risk of any adverse price movement and to avoid the company used to protect itself against the loss in investment by making a balanced transaction. So, sa hedging decision, ito yung sila yung nagmi-minimize ng risk na pwedeng mangyari sa isang transaction ng company. So, sa working capital management, it's operating efficiently by using working capital to the best effect. For the long-term investment analysis, we have, it is an account of a company plans to keep at least a year, katulad ng stocks, bonds, or real estate or cash. Ito yung companies plan to keep at least a year. So, the long-term investment analysis and the long-term financial decisions. For the long-term financial decisions, it focuses naman on borrowing and allocation of funds required for the investment decision of the firm. So, sila yung nag-allocate ng funds na required. Next is forecasting floating range. So, sa forecasting floating range, Currency forecasting and market efficiency. The efficient market hypothesis holds that number 1, spot rates reflect all current information and adjust quickly to new information. Number 2, it is impossible for any market to analyst to consistently beat the market. And number 3, all currencies are fairly priced. Financial theories define 3 forms of market efficiency. Number 1, weak form efficiency, semi-strong efficiency, and strong form efficiency. For the weak form efficiency, it implies that all information contained in past exchange rate movements is fully reflected on a current exchange rate. So, sabi niya dito yung weak efficiency, ito yung parang nagko-contain siya ng past that nire-reflect nila sa current exchange rate. Sa semi-strong efficiency, it suggests that the current exchange rate reflect publicly available information, thereby making such informations useless for forecasting change rate movements. And another one is for a strong form efficiency. It indicates the current exchange rate that pertinent informations, whether publicly available or privately held. So, next is the fundamental analysis. It is a currency forecasting technique that uses a fundamental relationship between an economic variables and exchange rates. So, ito yung method na nagme-measure ng value at saka nag-i-examine ng value ng isang company in the financial factor. So, ito yung formula for the fundamental analysis. We have the ET is equals to EO times 1 open parenthesis plus 1D over T and divide by 1 plus IF and raised to T. So, ito yung gagamitin natin example for the fundamental analysis. We assume that the spot rate is 0.73 per Australian dollar. The USA will have an inflation rate of 3% per year for the next 2 years, while we have an inflation rate of 5% per year over the same period. What will the US dollar price of the Australian dollar be in 2 years? So, using the equation, we have the E2 is equals to 0.73 times 1, which is the given equation na sinabi ko kanina, 1 plus 0.3 raised to 2 because for the 2 years and over 0.05%. So, saan natin nakuha yung 0.03, 0.05? Ito yung naka-indicate sa questions, example natin na percent. So, magiging, ang total niyan is 0.7025. So, we expected that the spot rate for the Australian dollar in 2 years is 0.7025. Yan yung na-expect na maging dollar rate in 2 years. So, multiple regression analysis is a systematic effort at uncovering functional relationship between a set of independent macroeconomic variables and dependent variables, namely. So, some multi-regression analysis, it is used to analyze the relationship between a single dependent variable and several independent variables. So, here's a formula of multiple regression analysis. The PP is equals to BO plus B1 plus B2M plus B3N and plus yung ganong sign. So, example natin dyan is assume that the following values of BO is 0.01, 0.5 for B1, 0.8 for B2, and 1 for B3. So, ayan. Makikita natin dyan sa problem. PP is equal to 0.01, which is the BO, 0.05, the B1, plus 0.8, the B2, and the B3 for 1, and the N is for the percent per percent. So, ipagta-times lang natin yung dalawang, naka-close parenthesis, tapos ibababa. Yung sagot din sa mga yan yung ipag-add natin na 0.1 plus 1% plus 2%, 2.4 plus 4% is equals to 0.5%. So, next, we move on to technical analysis. For technical analysis, we have it is used for forecasting the directions of price, through the study of past market media, primarily price and value. So, sabi dito, so for charting, we have, it is identified the trends through the use of charts. Practitioner must find the peaks and troughs on the price series. So, parang dito, hahanapin na lang yung pinakamataas at saka pinakamababang price na meron yung isang transactions. Next is mechanical rules. So, mechanical rules, sabi dito is, it is a subjective system requires them to use judgment and skill in finding the interpreting patterns. For mechanical rules, avoid this subjectivity. These rules impose consistency and discipline on technical analysis by requiring them to use rules based on mathematical functions to present the past exchange rate. So, sabi dito sa mechanical rules, kailangan nilang gumamit ng parang mathematical functions. Yun ang kailangan nilang gamiting base for the functions of present and past exchange rate. Sa next is market-based forecast. For the market-based forecast, it is a market indicator such as forward rates. The empirical evidence of the relationship between the exchange rate is the market indicators implies the financial markets of industrial countries efficiently incorporate expected currency changes on the spot rate, the forward rate, and the cost of money. So, the spot rate. What is the spot rate? Some company track changes in the spot rate and then use these changes to estimate the future spot rate. So, sabi dito, yung sa spot rate, ito yung ginagamit nila para malaman yung pagbabago ng currency or currency rate sa future. Next is forward rate naman. It is the expectation theory assumes that the current forward rate is an consensus forecast of the spot rate in the future. For example, we have the 30-day yen forward rate is a market forecast of the spot rate that will exist in 30 days. So, here's the evaluation of exchange rate forecast performance. We have RSE is equals to FB close parenthesis minus RV raised to 2 over RV. So, we have the example for that. We assume that the forecasted value of Canadian dollar is 0.7,300 and its realized value is 0.7,500. For the Mexican peso naman is 1,100 and its realized value is 1,000. So, the dollar difference between the forecasted value and the realized value is 0.0200. For the Canadian dollar and 0.0100 for the peso. So, makikita natin dito yung ginamit nating formula kanina. 0.7300 which the value of Canadian and 0.7300 for the Canadian dollar and 0.7,500 for the realized value of the Canadian dollar over the 0.7,500 of the realized value of Canadian dollar is equals to 0.23. So, ganun lang para makuha natin yung evaluation of exchange rate forecast performance. So, next we have the forecasting fixed exchange rates. Forecasting fixed exchange rate. So, what is forecasting fixed exchange rate? It is an fixed exchange rate that believed to be determine a floating exchange rate system. However, many international monetary funds member countries have used form of fixed exchange rate. The annual report of the International Monetary Fund. So, dito naka-consist yung mga steps na meron ng forecasting fixed exchange rate. We have the step 1, the assessing the balance of payments outlook. So, sa step 1, we have international Reserves, sabi dito, international reserves reflects the solvency of a country. It is ability to meet the international obligations. Yung parang mga international obligations. Next is the balance of foreign trade. It is forecast for the balance of a foreign trade indicate the direction in which the value of currency is to be adjusted. So, kailangan malaman nila yung balance ng isang foreign trade para alam nila yung magiging i-adjust nila magiging value ng isang foreign rates. Next one is inflation. What is inflation? It is a force linked the prices of a real asset with the price of currencies. The relationship between inflation rates, exchange rates provided by purchasing the power of primitive doctrine. So, next one is money supply. For the money supply, we have a currency in circulation and demands deposits. For the official versus market rates, it is used to the exchange spread between official and the market rates as a valid indicator of a currency health. Next one is the step 2, the measuring the magnitude of the required adjustment. We have the generalized application of the PP theory. So, under the generalized application of the PP theory hypothesis, the percentage change in the exchange rate between any two currencies can be estimated by inflation rate differentials between of two countries. Sabi niya dito, sa may generalized application PP, ito yung application form hypothesis na ginagamit nila para malaman yung pagbabago ng isang exchange rate between two companies in caused by or estimated by inflation. So, for forward premium discount, an unbiased estimate for the future percentage evaluation of devaluations of a currency may be provided by forward premium or discounts. It is more focused on premium or discounts of revaluation, pagtaas or pagbaba ng currency. The next one is the free market rate. It is a forward exchange market. The exchange rate quoted by the free market can be used as indicator for the future spot rate. Next one is the step 3, the timing and the adjustment. So, for the timing and the adjustments, once a forecast have estimated the pressure of a company's currency based on the discrepancy between the forecasted rate and the actual rate, they will evaluate the resistance capacity of a country under pressure to adjust. The country available to resist the postponed implications of corrective policies depend of two factors, which is the ability to borrow hard currencies and the overall amount of internal services. For the step 4, we have the nature of adjustments. We have corrective policies. In this case, structural balance of payments deficits policymakers will first attempt to implement a number of corrective policies, deflate the economy, and institute a strict exchange controls, among others. So, it's more concerns about the policies in foreign exchange rate. Next one is the devaluation. For the devaluations, it is a country will devalue a currency with various corrective policies, prove economically ineffective or politically unacceptable. To determine how much long a devaluation can be delayed for purely political reason, the currency analyst will have to review the political factors in a qualitative manner. So, sabi dito, bago sila mag-devaluate ng isang foreign exchange rate, kailangan meron silang parang political reasons na mag-a-analyze or mag-review ng political factors na using the qualitative manner. So, why and how central banks intervene in currency market? In a system of fixed exchange rate, central banks frequently intervene the foreign exchange market to maintain the par value system. Even within the flexible exchange rate, central banks intervene the foreign exchange market to maintain orderly trading conditions. Monetary authorities normally intervene the foreign exchange rate market as number 1, to smooth exchange rate movement, number 2, to establish implicit exchange rate boundaries, and number 3 is to respond to temporary disturbance depending on the market conditions and as central bank. So, sabi dito, yung for pagbabago ng isang foreign rate ng isang bansa, hindi to basta